So how do we trade the gap rule? Well, this is one of my favorite trade setups, and for good reason. We've got 4 different unique plays we can implement when talking about gaps and trade strategy. Now, I'm going to show you the basic principles and the basic pattern play behind, what a gap day would look like. Before we get to that, let's just discuss what types of gaps we get. Okay, so the first we get is a technical gap, and the second would be a fundamental gap. Now don't forget, guys, a gap in its own is a form of excess. Okay, it's showing us the market is highly skewed, or there's a real lack of balance in the marketplace. So what we need to interpret firstly is what has created this excess, or this very, very non-symmetrical shape in the market. Well, firstly, could it be technical? In other words, have we had a huge move overnight in, say, Asia, and as a result, the market is, opening up below an area of stop-out positions or a liquidation period? So that's the first thing we need to interpret. What has created the gap in the market? Second, is it a fundamental gap? In other words, have we received some form of information overnight, some sort of a, something from maybe a central bank, or maybe there's some huge political news out? Is there a fundamental reason that price needs to very aggressively shift? So that's the first thing we need to interpret. Now, the reason is because technical gaps have a high probability, or a higher probability, of actually filling not just in that session, but in sessions thereafter. Whereas fundamental gaps, on the other hand, they have a slightly lower probability of filling within that session, and even sometimes later sessions. So that's the first thing we want to interpret when talking about gaps and excess. Now, the play is very simple. Okay? We want to interpret whether or not the gap holds. Now, as a rule of thumb, always remember, if the gap holds in the market, so let's say that's our previous day's low, and let's say this is the previous day's opening price. Now, this gap effectively tells us there's initiative, or potential for initiative, or skew, or probability. So straight away, you should see gap, you should see something like maybe dollar signs, because that's what a gap means. A gap means there is potential for opportunity and probability in the market. Now remember what we spoke about in earlier slides. We said when there's a skew in the market, or a market that's out of balance, it's going to force lots of different positions, whether it's initiative positions, whether it's responsive buying, whether it's initiative selling. It's going to force a lot of business, or a lot of players into the market, because suddenly prices shifted from there down to there. Now, that creates opportunity for us as traders. However, we need to have unique strategies to implement and take advantage of the gap. So the first and most aggressive type of gap trade strategy will be where the gap does not fill. So let's take a look at what this example would typically look like. So we have the previous day's profile. We then have the gap formed, and today we've opened and gapped on the previous day's range. Now, the first example is where the market opens, it facilitates trade in either direction, we distribute, but we cannot fill in the gap to the outside even after attempting. Now, this is the key to this trade strategy. We need to see the attempt made. Now, this attempt would typically come as the cash market opens. Now, a lot of traders, what they tend to do is they get a little bit too aggressive in these gap strategies, and the reason is because they've come in, they've heard this news, they're thinking, oh, I better get on it, otherwise I'm going to miss it. And what they end up doing is they end up getting on that down leg, whilst the market is just trying to find a little bit of balance after having gapped. Remember, guys, when a market has gapped, let's say this market has gapped down 2%. That's a relatively large move. In other words, the market should almost be fully reflecting the new information. So bear that in mind, that the market needs to attempt. We need to see the K print, the L print, maybe the N print, the N print. We need to see maybe a couple prints. Well, it doesn't matter what they are. We need to see a couple of prints failing to fill that gap in. once we fail to fill that gap in and the market starts to look a little bit top heavy and starts to rotate lower and hold higher or lower and lower auctions, we then should see a continuation of the trend. So that's the most aggressive type of gap rule. But remember, we need to first see the attempt made at filling the gap. Now, let's take the second most aggressive example, where the market fills the gap but fails to re-enter the previous day's range. So we have our gap, the market opens lower, it trades both sides, and it starts to distribute, and eventually it distributes all the way up and fills the previous day's range. So we no longer have a gap in the market. Now, this is the second most aggressive, because if the market cannot get back inside the previous day's range, it's telling us that we still have quite a strong sentiment towards the downside. Now, the key to this trade strategy is again a little bit of patience. This is the one we tend to find that occurs most often with gaps. Markets don't like to leave gaps. Why? Because structurally they look very awkward. Structurally they don't make much sense. So very often the market tends to fill in the gap, but once it's kind of filled that gap in, it can then look to continue to distribute lower. Now, the key with this strategy is to allow the market to fill that gap, to allow the market to show us that a top is now in place. And once it's allowed us and showed us that top, whether it's a top formed on a tail, it's a top formed on maybe a slowing momentum, whatever it may be, once that top is formed, we then start to see again the distribution towards the downside or the lower end of the profile. So again, the reason we talk about the most aggressive and second most aggressive is that these are the most likely to show us or to hold the natural short-term bias, which in this case, because the gap is to the downside, will be to the downside. Now the third, and again, this one's also particularly good to trade, is when we actually get the gap that gets filled and we re-enter the previous day's range. So again, we gap. The market facilitates trade on both sides. However, after distributing for most of the morning, we then re-enter into the previous day's range. Now, the key with this strategy, and listen carefully because this is a particularly good strategy, the key with this strategy is to ask yourself what has created the gap, and it comes back to the question of, is it technical or fundamental? Now, the reason this is a key strategy is because if there is a fundamental reasoning behind the gap, you are going to get a lot of positioning. Okay, now what do I mean by that? So let's say overnight we hear some very, very aggressive news. A lot of short-term traders come into the market and all they're thinking is about the fundamentals. So we have a lot of aggressive shorts that have initiated new business in the market. Now, by that very token, if people are initiating shorts, but the market cannot go down, it's telling us there's going to be a lot of short-term trapped short positions. And once those short-term positions get squeezed a little bit too far, we tend to get a very aggressive reversal in the opposite direction. The last and the most sort of aggressive reversal type price response is where we actually not only get into the previous day's value area, but we then extend to the other side of the previous day's value area. So this is very similar to the third example. The only difference is we lean on the previous day's value or volume value area low. So that becomes a key pivot for us. If the market initially holds this area as resistance, let me make this a little bit better. So the market holds this initial as resistance, but then it starts to trade above it, it's highly likely we're going to trade very quickly and aggressively to the other side of accepted value. So that would be the fourth example we'd look for, and it's very similar to the third. The only difference is we have a calculated target, which would be once we get above the previous day's value area low, we tend to then target the previous day's value area high. So those are the four examples. Now, the reason I show you these strategies, again, it's not that I want you to necessarily become, a professional gap trader. What I just want to point out to you is that when there are gaps in the markets, on any day, it doesn't matter which day of the year it is or which market, when there is a gap, already I have got 4 trade opportunities listed on any given day where there's a gap. So straight away, I have a strategy, I have an approach as to how I'm going to trade gap days. All I have to do is just follow the structured strategies I've shown you and execute accordingly. If you follow this roadmap, guys, you will succeed at not just the trading, but at developing some fantastic trade opportunities. So that's our gap rule trade strategy. I hope you've enjoyed that, and we'll catch up again in the next few slides.